Welcome everybody then to fair value accounting, used in lots of standards. Let's just get a good grip of it. So the definition, the price that would be received to sell an asset or paid to transfer a liability in a transaction that you're not forced into, so an orderly one, between market participants. You'll see the market word come up all the time at the measurement date. So the whole idea is, don't worry about this at the moment, but it's an exit price, not an entry price. If there's more than one market, you choose the principal or the most advantageous market. And you'll notice that I'm using the word market a lot because it's a market-based value, ideally. Okay, so there's actually 3 levels of inputs into your fair value. So you're deciding how to make a fair value of a table. Well, there's 3 levels of inputs that will give you the fair value of that table. And you would choose level 1 first. If there wasn't a level 1, you'd choose a level 2. If there wasn't a level 2, you'd choose level 3. Now, if you were trying to work out the fair value of a table, how would you work it out? You would probably go straight to the market, wouldn't you? eBay or whatever. And let's have a look at the cost of this table on eBay of a similar age. So that's what level 1 is. Quoted price in an active market. If you haven't got one of those, you would do, is there anything else I can look at? Anything else that's observable, that's not level 1, that's not in an active market? And an example of that would be quoted prices for similar assets. So not this exact table, but a similar one. And finally, ones you can't observe, you can't go look for, so you've got to make it up yourself, like a cash flow forecast. How much cash does this table bring me in? Probably nothing. But anyway, there you go. Level 1, level 2, level 3. They're the sorts of inputs into the fair values. And you obviously go level 1 first, level 2 second, level 3 third. There's also different valuation approaches. We've said market is the best, but there's cost and there's income. So the market-based approach would be to look for either identical or comparable items. If not, then maybe you could go for what would be the cost of replacing this asset. And if you can't do that, what's the discounted cash flow of this asset? Okay, so different valuation approaches as well. So if we're thinking of a non-financial asset, like my table, you would use the highest and best use concept that's physically possible for a table, that's legally permissible for a table, and that's financially feasible for a table. In your exam, it won't be a table. It will be something like an investment property or something. So here we have an investment property, has no identical assets trading in the market, so we're not using level 1. However, similar properties recently sold for 1.5 million. Okay, so we can use similar properties. Differences in location and condition mean a 10% adjustment. And it says, oh, and by the way, you can get rental income of 120,000 a year and the market yields are 8%. So you say, right, well, there's a market valuation I can do, a market approach, which would give me 1.5 million times by 90%, which is 1.35 million. Or I could use an income valuation. What income will this item bring me in? And it'll bring me in 120,000 every year, what we call an annuity. To work out the value of the annuity, divide it by its discount rate, which in this case is 8%. So that will get you to 1.5 million. So the one you decide would be the one that gives you the most reliable estimate based on the market conditions, based on data availability. And if they were both as reliable as each other, you would take the income valuation because it's its highest and best use. How do you value your own shares? Well, if you're a public limited company, you'd use the market value, obviously. But if you're not, you'd use a valuation technique that reflects your company's own credit risk. So make sure you do that. If you're trying to value a liability, just make sure you're assuming transfer to a market participant, not a family friend or whatever. So if a company issues a 5-year bond with no market participant, well, what do? Well, again, you're down to this income-based approach. It uses a discounted cash flow method, good, with the following data. £1 million it needs to be paid back. You have to pay back 5% interest a year, and the market discount rate, that's the rate you want, would be 6%. So you'd have to discount down the interest, and that's just the way of discounting down interest. I'm not here to teach you that at the moment, but 50,000 a year for 5 years, discounted down at 6%, is 210,000 in total. The principal is 1 million divided by 1.06 to the power of 5, because it's the end of the 5 years you get that money, you have to pay that money. So 747, add the two together, and that would give you the fair value of the liability. Okay, it was a quick recap, but I really hope it helped.